Welcome to our fixed income learning session. In this video, we will discuss what fixed income is, how pricing and valuation work, and the three factors to consider: sectors, quality, and duration, which is sensitivity to interest rates. We will then explain the role fixed income plays in a portfolio and the various ways to invest in fixed income securities. So let's get started. Fixed income generally refers to bonds, which are a type of investment under which the investor lends money to an institution in exchange for interest or coupon payments and receives the principal amount at the end of the period. The borrower or issuer is obliged to make interest payments of a fixed amount on a fixed schedule. Common borrowers are companies, local municipalities, states, or national governments. For example, an investor buys a 10-year U.S. Treasury bond for the value of $1,000 with a coupon payment of 3% or $30 per year. They will receive twice yearly interest payments of $15, plus the original $1,000 at maturity after 10 years. Now, interest rates change from time to time, so let's spend some time looking at how changing interest rates impact the value of a bond. When interest rates rise, bond prices fall, and conversely, when interest rates fall, bond prices rise. For example, if the market rate of interest for a 10-year bond increases to 4%, the value of a 3% fixed coupon bond will decline. This is because an investor will not pay as much for a 3% coupon bond in an environment with a going rate of interest of 4%. Now let's discuss the sectors in the fixed income market. There are 5 major sectors. These are government bonds, municipal bonds, corporate bonds, securitized bonds, and international bonds. Government bonds are issued by national governments. These are generally perceived to have the lowest risk because they're backed by the full faith and credit of the issuing country. In the US, for instance, we have treasury bonds. Municipal bonds are issued by states, cities, and other local entities. The funds are usually used for public service projects like building highways or schools. Corporate bonds are issued by companies to raise capital. They can range from extremely safe to very risky, depending on the company's financial health. Securitized bonds are asset-backed securities, which are pools of loans backed by assets, like mortgages or car loans, which are packaged together and sold as bonds. Finally, international bonds are issued by governments or corporations in foreign countries. Moving on to bond quality. This refers to the creditworthiness of the bond issuer. It's a measure of how likely the issuer is to make all the required payments, both interest and principal, as well as pay you back at maturity. Just like an individual has a credit score, bond issues are given a credit rating by rating agencies like Moody's and S&P. Ratings range from AAA to single C, with AAA being the highest qualities. Bonds are typically grouped into buckets based on their credit quality. Investment-grade bonds are high-quality bonds considered to have low risk of default. They are usually assigned a rating of BBB or higher. High-yield or junk bonds have a lower credit quality. They have higher risk of default and hence offer a higher potential return to compensate for the added risk. They are rated below BBB. Just like the equity market, investors have to balance their risk and reward opportunities in the bond market. The benefit of a fixed income security is because relative to equities, it creates a fairly stable income stream and fairly reliable indication that you'll receive the amount you initially invested. Therefore, it's far less volatile than equities. As we've talked about previously, risk and reward are interconnected. Because fixed income is generally lower risk, the expected returns are often lower than equities over the long term. Their main purpose in a portfolio is to provide stability and diversify your risk exposure against other asset classes. Duration is a crucial concept in fixed income. It measures how sensitive a bond's price is to changes in interest rates. The higher the duration, the more sensitive a bond is to interest rate changes. The duration of a bond is a function of length to maturity and coupon payments. The longer the maturity and lower the coupon payment, the higher the duration or sensitivity to a change in interest rates, and vice versa. Imagine you have a bond that matures in 2 years versus one that matures in 20 years. If interest rates go up, the bond with the longer time to maturity will see a more significant decline in its price compared to the shorter bond. Why is this? Going back to our original example, the investor is holding on to a bond that has lower payments for a longer period of time, in addition to a longer payback period of the principal amount, both of which erodes the value as you consider inflation and other discounting factors. Investors looking to reduce the risk associated with interest rate fluctuations might opt for bonds with shorter durations. The world of fixed income is vast and varied, encompassing different sectors, qualities, and durations. Whether you're an investor seeking stable periodic income, diversification, or capital preservation, understanding these fundamental aspects of fixed income securities can greatly enhance your decision-making process for your investment portfolio.